500 futures are off slightly. Let's continue the conversation with Mickey Cargile. He is the managing partner at Cargile Investments. He joins us live, as well as our guest host, Keith McCullough, CEO of Cargile Risk Management, who joins me on set. Mickey, I want to start with you. How much is what's going on in Japan isolated to Japan's economy, and will that trickle over to us, leading to a double dip?
No, I don't expect there's going to be a double dip at all. I think that our economy is strong. It's growing slowly, but it's a very strong growth. And corporations are well set to expand their profitability. You know, they're so lean right now. That's one reason we have such a high unemployment rate. But with that productivity that they've built into the companies, just a slight increase in demand will translate directly to the bottom line of these companies.
Well, Mickey, there's a big difference. It's Keith McCullough from Cargile Risk Management. There's a big difference between running lean and having a strong economy that has employment, and certainly not the ancillary effects associated with inflation. So this morning we're going to get a CPI report and a PPI report, actually in the next 2 days, that are inflationary. At the same time, you're going to see growth slowing associated with what's going on in Asia. Do you compute any of that into your assumptions that all things U.S. growth is fine?
Well, I don't want to say it's necessarily fine. I mean, it's not at an optimum point. However, it is at a point with stocks at the values they are now where it's a great time for the individual investor, if they haven't been participating in this market, to start allocating their risk assets toward the equity market. Now, we're very strong believers in the American market, and we think it's a good time to be buying American stocks.
Well, for me, patriotism isn't always a catalyst, neither is valuation. So certainly we've had a big run, with 98% rally from the March 9th low. I have a hard time finding value in a stagflation environment if that's indeed what we're seeing, slowing growth and accelerating inflation. So if you go back to the late 70s, when people would pay 6 to 8 times earnings as their normalized multiple, what do you think about that?
Well, the multiple that we paid in the 70s was quite different than it is today, because interest rates are basically zero right now. We have a very accommodative Fed, and the corporations are just a much better cash generator today than they were in the 70s. If you remember, in the 70s, we couldn't really build a car that would stay together. We couldn't manufacture domestic steel. We had to import all of our steel. Today, we have upgraded the industry in America, and don't mistake my endorsement of American stocks as blind patriotism. You know, we believe this is where the best value is right now.
Yeah, but gentlemen, we have investors who are writing into us looking for the best value. Patriotism aside, we are getting a question specifically in from David. I want to first throw it to Keith and then bring it over to Mickey. How much and what should be a fixed income portion of one's portfolio for the next 6 months or until the end of 2011? Well,
I think in an inflationary environment, which we've clearly had in the last 6 months, the last thing you want to be long of is treasuries. I think now, as you see a deflating of inflation, we've seen a significant sell-off in things like food, certainly of oil. You want to take fixed income, I'd say, into the 15 to 20% range of total, assets in your asset allocation.
Mickey?
Every investor has to use the fixed income portion of their portfolio to temper the risk in their equities. There is great opportunity in the high yield corporate bond market, and also the sell-off we've had in municipal securities gives us an opportunity to buy some good tax-free bonds in credits that you know, and as long as you know who you're lending the money to, I think you can make some good money in these types of investments. Now, whenever I start looking at inflation, I start listening to the Fed, and we can argue all day about whether the Fed is measuring inflation properly or not, but they're telling us that inflation is no long-term risk, and with that, they're going to continue their accommodation, and I think we have to listen to what they have to say.
Yeah, well, the UK and the US are pretty much the only central banks that are denying inflation, some say making it worse. Listen, guys, we'll continue the conversation. Mickey and Keith, stick around for the rest of the hour. We'll get some more questions to you in just a bit. Still to come, oil prices are caught in a tug-of-war between competing factors in Japan and the Middle East. Also off about 9. S&P 500 futures are off 3. Still with us, Mickey Cargile. He is the managing partner at Cargile Investments. Keith McCullough, our guest host for the entire hour, CEO of Cargile Risk Management. Keith, are we concerned about Japan because it makes us nervous about our own monetary, our own debt state?
Yeah, I think that's actually the #1 takeaway from Japan. Notwithstanding, the big issue from the natural disaster. The big takeaway here is the disaster that is debt. Japan has 998 trillion yen in debt. I don't even think people even know what to think about that number anymore. We are numb to it. They've attempted to basically stimulate the economy since 1992. The average GDP in Japan since 1992, average GDP is not 0.85% or 0.85%. So if you fundamentally believe that everything's all rosy in the U.S. with this deficit and debt spending, you really have to believe that debt doesn't structurally impair growth, and I fundamentally don't believe that.
And he has, Mickey, a growth target that is quite bearish, around 2%. Is that right?
Right. We're about half of what not only global growth estimates are for, for GDP, but also in the U.S. I think U.S. GDP estimates need to come up way down, and the consensus that Japan's not going to affect U.S. growth, I think, is reckless.
Mickey, what do you think about that? And we had Gary Schilling on last night talking about Japan being a slow-moving train wreck. Do you believe it's slow-moving? Do you believe it's fast-moving? Do you believe it's a train wreck at all?
Well, we've had 20 or 25 years where Japan has just basically stagnated. You think back to where we were when they were buying all the U.S. real estate, and it's quite a different picture today. They have not been able to really sustain a growth model for quite a while, and the fear is that the U.S. is on that same track. Hopefully, with the election that we had last year, that we're on a little bit more fiscally responsible track, and we can start reducing this debt. But yes, definitely, our debt is very important to us all. We need to get government out of business, and we also need to eliminate a lot of this overspending. It's just like a child with a Visa card that's over their limit. We just need to stop spending so much.
I think, gentlemen, I think I've actually found the one place where you two can agree. Mickey, Keith, we appreciate your time this morning. Thank you so much. That's going to do it for Worldwide Exchange. I'm Nicole Lappin in the United States, along with Christine Tan in Singapore and Ross Westgate in London. Thank you so much for your company today on Worldwide Exchange.